Tyler, you ready to get obscure?
Jason, you just read my mind.
No, it's true. And anybody that's watched one video with me and you, Tyler, they probably realize that. But we both are going to talk about a couple of stocks that are pretty obscure, not very well known at all, under the radar, however you want to describe it. We're going to talk about them because number one, we like the business. 1A, we love the price. They're just way too cheap to overlook right now.
That's kind of the core tenet of investing. So here we go. Let's actually do our jobs here.
I'm Jason Hall. He is Tyler Crow. This is Investing Unscripted. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. One video, one link. That's 12 great stock ideas. Be sure to check out the link. Okay, Tyler, how about you kick us off? Because yours is definitely man, they're both so obscure. Who knows? But yours is pretty obscure.
It is, unless you've gone to university, gone to college, whatever you want to call it. The one I've been looking at a lot, and it's really interesting to me, is SLM Corp. It used to be called Sally May. If anybody remember, it kind of thinks of that name a little bit more familiar. Sally May is what are they called? Government services entities that are designed to basically be like backstops or kind of the financing arm of basic things that the government wants to kind of provide liquidity to. If you know Fannie Mae, Freddie Mac are both examples of government service entities. Sally Mae was kind of a hybrid version of this, but instead of doing mortgages, they focused on student loans, and it was kind of a way of providing a secondary market for graduate student loans. So when like the banks would actually build these loans and didn't want to hold a bunch of student loans on their books all the time, Sally Mae says, "Yeah, we'll buy them, and it will hold on to them because that's kind of our job." And it sounds like a very uninteresting business, which is fine. I mean, it's owning mortgages and basically getting the yield on that, and borrowing from the Federal Reserve to make it happen, and you get a net interest spread, very much like a bank. But the only difference is that unlike banks, they don't have the big depositor base or anything like that, or the tiered capital structures that you would typically have because it's a government service entities. It's very limited in the things they can invest. What is relatively attractive to me to this particular business is that SLM Corp focuses more on private loans, which are a little bit higher interest, and they've focused more on graduate student loans. So if you're going to get your graduate degree, especially in law or in medicine, where you have really, really high financing costs for business school or medical school or law school, this is where SLM really starts to shine. If you look at their net interest spreads, they're several percentage points higher than you would get in a lot of the other government service entities. I think, for example, the current one that's still publicly traded is called Agricultural Farmers Mortgage, AGM, Farmer Mac. They have like a 1% net interest spread versus SLM Corp's, which is closer to 3.5. So the profitability for SLM Corp is considerably higher. And the thing that's been really interesting over the past couple of years is that they don't want to get too big, because then you start running into, capital liquidity requirements and things that management isn't 100% on board with, kind of, having to go through all that rigmarole. So they're doing what's called managed balance sheet growth, where it's they'll write all these loans and they'll backstop them, but sometimes they'll also package these loans to in large bundles, not too similar to a collateralized debt obligation, and selling them off to pensions and things like that that are looking for a high yield product. As a result, it's been able to buy back its stock at considerable rates. From January of 2019 to today, it's bought back about half of its shares outstanding. And today, despite the kind of very shareholder friendly practices that it's had with a 2% dividend that's growing at a good rate, buying back a ton of stock, and a relatively profitable and likely going to stick around for a long time. I don't see a version where we stop taking out loans for grad school. With all of those things in mind, we have a business that's trading at 8 times earnings. And for me, this just looks like a mispriced asset that looks extremely attractive to me right now.
A lot of times you don't hear somebody talk about stocks that are too cheap to ignore when the stock price has gone up more than double, right, over the past 10 years. And of course, from the pandemic lows, has gone up a ton. A lot of that is the fact that a massive amount of the float has been repurchased by the business. And you talked about trying to manage their growth, and they are growing, right? That's a key. Again, this is the pandemic caused this decline, and then we've seen it start to redeliver in some above average growth, right? So you combine growing at a reasonably high rate and you get the kind of returns that this business generates, put it all together, and I think you've got something pretty compelling there, Tyler. You ready to talk about mine?
Let's do this. Where are you going, Jason? Because this is probably the one time where yours is more obscure than mine.
That's true. Let's go to the islands. Let's go to the Cayman Islands. What do you say?
Nothing good comes out of the Cayman Islands, Jason. Come on. You're not selling me yet.
Okay, how about the Channel Islands over Jersey and Guernsey over in the English Channel? We'll go there. We'll go there. No,
sounds a little
okay.
better.
Well,
Let's go.
we're going to go to Bermuda because that's where the corporate headquarters is for Bank of NT Butterfield and Sons. Man, that's a household name, isn't it? This is a bank. It is a commercial bank. They also do financial services and other wealth planning and other banky kind of services, typically focused on very high net wealth clients. One of the oldest banks that's located in Bermuda. Again, they have operations in Cayman Islands, Jersey, and Guernsey. This is a business that has performed quite well over the past 5 or 6 years. It's been public for less than a decade. The stock hasn't generated great returns in terms of the stock price over the past decade, but dealing with a lot of the same pressures other banks have faced, Tyler, where we've seen interest rates skyrocket, and rising interest rates generally should be good for banks over the long term. When they happen really fast, they can put pressure on a business. The business has done a lot to shift its income source away from just yield, that spread you're talking about. It also earns a pretty substantial fees-based income. And they've done a lot of things to grow their high touch personal services, financial services they provide. They're really valuable to a lot of their high net wealth clientele. And it's paid off pretty well. I'm going to show a couple of slides here from their presentation when they reported fourth quarter results. We'll talk about some of the things that really matter. So key thing right here, net interest margin, 2.73%. That's pretty solid. That's a little better than you see from some of the large US-based banks. Cost of deposits, 1.72%, not super high. In this high interest rate environment that we've seen, it is certainly higher than you're seeing from, again, the JP Morgans and Wells Fargos of the world that have these ultra low yield costs. But the point is that they continue to get a really good yield on their money. They've been able to support this 44 cents per share quarterly dividend quite well. Earned over $1 per share in the fourth quarter. They earn a lot more than they pay out, so the yield is pretty safe. Again, the stock's kind of been in the doldrums for a while, but even looking past the stock price and just thinking about pure valuation, if you look at it on a price to earnings ratio, trades for less than 7 times trailing earnings. Since 2018, the average has been about 10 times. So that is a substantial discount to its potential earnings power. And on a book value basis as well, because this is a bank that caters to really high net wealth individuals, doesn't have tons of physical locations. It does tend to trade for a higher book value than you see from large traditional banks that have hundreds or even thousands of physical locations. Again, the book value is typically almost 2 times, trades for less than 1.5 times right now. So you put those things together and it looks really cheap. The last thing I want to say about valuation too is I mentioned the dividend and how it's really safe, protected by a lot of income. You're getting a 5.5% yield. That's a great yield for a safe stock, really well positioned, trading for a super cheap valuation.